Hey guys, Greg Silverman here for Cios and Bowties, and a little roundup of articles that you've all liked and shared over the last week or two. So quick synopsis there. Listen, first of all, I want to say what is going to make this market ever go down? I mean, COVID spiking, all-time highs, election turmoil, and nothing seems to worry this market. Although I would say, and we get into this a bit later, the FANGs or the NASDAQ has been leveling off for some time. So we'll just wait and see. Okay, onto the articles. First one that you all liked. What does it take to scale an AI company? Founders and investors share their insights. When they talk about scaling a company, they're talking about $1 billion plus valuation, the old unicorn sign. Simon Greenman at Best Practices AI cites 4 reasons to look for in an AI company for scalability. 1, is the company solving for a high value use case, so a big 10x type problem? Does the team have deep domain expertise and access to data sets? Obviously, AI is highly dependent on learning from data. Deep technical expertise goes without saying. Commercial and selling experience. Look, you can have the best product in the world. If you can't commercialize it, if you can't sell it, it's going to stay on the shelves and it's never going to be worth $1 billion plus company. All right, next article. This one's actually very interesting. Rent or buy. 8 home hunters explain their real estate moves during COVID. It's a great article. You should check it out. Look, supply of homes is at somewhat at all-time lows, and demand is very high because of low mortgage rates. And that's not just a US experience. It's across the globe: UK, Australia, Canada, Germany as well, other countries. 5 examples. 1, a person in New York moved from an apartment in Battery Park to upstate New York, exchanging their rent from $5,500 to $1,000 a month. They do talk about a culture shock moving to upstate New York out of New York City, so that's interesting. And of course, they get more space. There's an example of Atlanta. There's an example cited of Chicago. 30-year consultant upgrades his apartment, condo living, from paying $2,550 per month to $2,700, gets a bigger place, gets a better view. So inner city living is actually decreasing in the rental side, decreasing in price for rentals. The last one is a very interesting one. It talks about the Sydney market. In Sydney, in Australia, they auction off houses. So there's an auction where everyone gets together, and it's a kind of a fevered pitched auction process. And well, what do you know? Less people are showing up to auctions because of COVID. And so that benefited in this example. All right, next one. Stock market bets against NASDAQ index hitting decade peak. First of all, the market is up the NASDAQ is up 72% since March. So it's been quite a run. Talks about an indicator of short interest. So the amount of shares that are sold short is now at 10-year highs. That's at 9.7 billion shares sold short. The last time that happened was 2007, 2008. We know what happened there. 2015, there was a slight correction after that, but nothing major. So some people see this as a contrarian sign. Others see it as a warning indicator that the short interest is too high and the market cannot go much further. We'll just have to wait and see. I don't really know the answer. Next article, Tax Smart, what you earn versus what you keep. This one was written by Fidelity Investments. They talk about over a 40-year period that you're giving up about 1 to 2% return per year as a result of tax inefficiencies. That's quite significant. They can add up to millions of dollars over 40 years. So they cite a few things that they do or that can be used to help on the tax efficiency side. Transition management, when you're moving exposures from one area to another, you transition it slowly or methodically, and you manage it, in essence, making it more tax efficient. Watch out for those short versus long-term gains. You want to be holding wherever possible for a year and a day, get that long-term gain treatment. Harvest tax losses at the end of the year. That's become somewhat routine in the wealth management business, but you want to take into account those losses. Remember, you cannot buy back similar exposure within 30 days. Otherwise, those deductions are not allowable. Distributions, specifically around mutual funds, need to be observed carefully. Mutual fund distributions are not entirely dividends. They contain interest. They contain capital gains. So one needs to take great consideration into those and their tax efficiencies thereof. Tax smart withdrawals from tax-free accounts, IRAs, 401ks, etc. That needs to be planned very methodically. So tax planning, financial planning, very important when it comes to retirement and post-retirement. And of course, the old tax-exempt income, specifically around muni bonds. That's important consideration from taxation. So that's it, guys. Those are the 4 biggest articles that you've all liked. I wish you all a happy Thanksgiving, happy holiday season. We'll be watching with eagle eyes, seeing what the market brings next. This is Greg Silverman for CIs and Bowties, out.